Welcome to vTalkInsight, Market Drivers Daily for June 8th, 2026. Global markets are being pulled between three powerful forces today: an AI investment boom that is becoming far more capital-intensive, an energy shock tied to fragile Middle East ceasefires, and a rapid repricing toward higher interest rates. The key question is how long AI growth can offset the drag from expensive oil and tighter financial conditions. The AI story is transitioning from a phase of exuberant experimentation to a more demanding regime where cost, discipline, and real productivity matter far more. Rising costs for AI tokens and infrastructure means service providers are moving prices closer to their true economics, while corporate users are trimming low-value use cases and concentrating spend on workflows that clearly move the profit and loss statement. In recent weeks, we highlighted how AI capex was exploding across hyperscalers. Now that surge is colliding with budget constraints and higher rates, forcing a sharper focus on pricing power and return on investment. On the supply side of capital, the AI build-out is only getting heavier. Large technology firms have doubled their AI infrastructure spending from around $400 billion to roughly $800 billion in 5 years, and expectations point to further increases, supported by equity issuance and a crowded pipeline of mega IPOs tied to artificial intelligence. Names such as SpaceX and OpenAI are being framed as potential record-sized offerings, while other AI leaders are raising primary equity to fund data centers and chips, adding to equity supply just as valuations in core AI beneficiaries already screen rich. Beneath the headline volatility, there is a deepening layer of real economy infrastructure tied to AI. NVIDIA and SK Hynix are co-developing next-generation high-bandwidth memory for accelerators. Google is reported to be ordering more than 3 million specialized AI chips from Intel from 2028, and Brookfield is scaling long-dated AI data center projects in Europe backed by investment-grade contracts. These moves reinforce the idea that the AI theme now reaches far beyond mega-cap platforms, touching power, real estate, and industrial supply chains in ways that could support earnings for years, even if front-end equity multiples compress. Evidence of productivity improvement is starting to emerge, but it is uneven. Major banks report that AI has cut onboarding and KYC times roughly in half, while a leading managed care group has already booked about $1 billion of cost savings in the first year of deployment. Yet most firms still say they're not seeing material profit uplift and need another 2 to 3 years. At the same time, large language models are becoming commoditized. Capital intensity is surging to the point that one high-profile AI infrastructure firm is spending more than twice its quarterly revenue on capex, and private equity tech deal values have dropped about 70% as investors reassess software valuations. Looking ahead, markets face a trade-off between powerful, long-term AI demand and near-term risk from stretch valuations, regulatory debate over government stakes and data rules, and the reality that AI is energy-hungry, tying this theme directly into today's geopolitics and inflation story. Geopolitics and energy are once again at the center of cross-asset pricing. Direct exchanges between Israel and Iran, including strikes on Iranian territory, missile launches, and threats to Red Sea shipping, have pushed Brent crude repeatedly toward the high $90 area, with intraday swings of 4 to 5% as markets react to each ceasefire headline. The Houthis' move to ban Israeli-linked vessels from the Red Sea, combined with a continued U.S. naval presence, has kept shipping activity through the region well below pre-conflict levels and entrenched a geopolitical premium in oil. Higher and more volatile crude prices are feeding through into pronounced sector rotations. European benchmarks opened down, with technology shares leading declines, even as regional oil majors outperformed and UK indices found some support from their heavy energy weighting. Airlines are on the other side of that trade. Industry profit forecasts have been cut roughly in half as jet fuel costs surge. Management teams talk about further ticket price hikes and potential capacity cuts in autumn, and weaker balance sheet carriers face rising default and consolidation risk. The inflation channel is where this energy shock matters most for macro. Several consumer-exposed companies now signal extra cost pressure if oil hovers near $100, with at least one large food producer flagging 2 to 3% additional inflation next year, and airlines warning that higher fares could eventually weigh on discretionary travel. Strategists see a non-trivial tail risk scenario where a further spike toward $125 to $150 a barrel could push headline inflation materially higher and add to downside risk for equities, particularly in Europe and energy importing Asia. There are, however, some tentative signs of the escalation. Reports that Iran's Revolutionary Guard declared an end to a recent operation, combined with talk of renewed ceasefire efforts, briefly sent crude from about $98 back toward the mid-90s and helped equity futures rebound, even though neither side has fully committed to a durable agreement. For portfolios, the key watch points now are the security of flows through the Strait of Hormuz and the Red Sea, inventory trends in a peak driving season, and how sensitive sectors such as airlines, consumer staples, and shipping adjust guidance as they digest higher fuel and freight costs. The rates narrative has swung decisively back toward renewed tightening risk. Stronger than expected U.S. payrolls and resilient activity data have pushed markets from debating the timing of cuts to pricing a substantial probability of a Federal Reserve hike by year-end, with some measures implying around a 70 to 75% chance. Two-year Treasury yields are now trading roughly 40 basis points above the policy rate. 10-year yields sit above 4.5%. And the 30-year remains north of 5%, underscoring how far expectations have shifted in just a few weeks. Upcoming inflation data will be critical in validating or challenging that repricing. Headline U.S. CPI is expected to print above 4% year-on-year, with some forecasts near 4.2%, and producers' prices are also in focus as higher energy and fertilizer costs feed through. Bond yields have already crept higher ahead of these releases, and several houses warn that a hotter-than-expected CPI or PPI print could push yields further up the curve and largely close the door on near-term rate cuts. The hawkish shift is not limited to the United States. The European Central Bank is widely expected to deliver a 25 basis point hike this week, with some investors bracing for additional moves by year-end despite weak euro area growth and mounting warnings about policy error. In the United Kingdom, short-dated gilt yields now reflect expectations for roughly 50 basis points of additional tightening by year-end, while Citi has raised its year-end rate forecast for a majority of the central banks it tracks, highlighting a broader global move toward more restrictive stances. For risk assets, the interaction of higher real yields and elevated energy prices is central. AI-exposed equities have already seen sharp pullbacks as higher discount rates meet rich valuations and heavy equity issuance. Crypto assets have lagged the broader risk rally, and liquidity-sensitive segments could face further pressure if financial conditions continue to tighten. Countering that, interest rate volatility remains contained. Central banks emphasize data dependence, and some observers still see the base case as an extended pause rather than an aggressive new hiking cycle. Given subdued wage growth and a global economy that has so far absorbed higher rates better than feared, the next inflection points are clear. U.S. CPI and PPI this week, the upcoming Fed and ECB meetings, and how far any renewed oil spike pushes inflation expectations, all of which will feed back into the cost of capital for AI capex and the broader equity rally. To wrap up, the AI trade is maturing into a more capital-intensive, selective phase, where pricing power and hard productivity gains matter far more than simple exposure to the theme. At the same time, fragile Middle East ceasefires are keeping an energy risk premium embedded in oil, feeding through into airlines, consumer sectors, and inflation data just as markets reprice toward higher for longer interest rates. Key watch points from here are U.S. CPI and PPI, the next Fed and ECB decisions, the stability of energy supply routes, and the market's capacity to digest large AI-related equity issuance without widening credit spreads. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.